We're going to investigate how you can get the best high yield on your savings with a yield as high as 9%. We're going to look at 4 closed-end funds paying a monthly dividend, so stay tuned for the full episode. Thank you for watching. This is Richard with Wisdom Investor. We're going to take a look at some closed-end funds that have attractive yields anywhere from 8 to 9%. Now, in general, you can get a rate between 6 to 10, but many times 8% and above on various closed-end funds. We're going to take a look at a couple of closed-end funds that are income-oriented, and we'll also look at a couple of funds that are orientated toward covered calls. In addition to that, we'll look at 3 other types of funds that are related to corporate bonds and also low duration bond funds. Typically, closed-end funds or CEFs typically pay a higher distribution or dividend than you would with your regular stocks or equity income type funds. So here's a graph here comparing equity income 2.44% versus 7.62, high yield 5.35 versus 8.36. Keep in mind, whenever we talk about a higher yield, especially 8-9%, and savings accounts only paying 1%, there is more risk involved. However, if you manage your money properly, you can make these closed-end funds or CEFs work for you. The first fund that we're going to look at here is called the Pimco Dynamic Income Fund. The symbols on this is PDI. Now, Pimco Dynamic Income, PDI, is showing a monthly distribution of 10.24%. Now, closed-end funds are very much like mutual funds. Many mutual funds that invest in equities are buying companies like Microsoft, Apple, Google, etc. And most of the income-oriented closed-end funds, what they're doing is they're buying bonds, government bonds, corporate bonds, securitized bonds. Keep in mind, those are some pretty good returns from the Dynamic Income Fund here for Pimco. One of the reasons they can do that is by using leverage. So these CEFs or closed-end funds that we're talking about here right now are more on the aggressive side. It's not the same as putting money into a CD, certificate deposit, or a savings account. The second Pimco fund that we're going to look at here, that's a closed-end fund, is the Pimco Corporate and Income Opportunities Fund, symbols PTY. The total share price distribution rate on this is 9.45%. Here's a little information here about the Pinco Corporate and Income Opportunity Fund. It says, under normal market conditions, the fund seeks to achieve its investment objective by investing at least 80% of its net asset plus borrowings for investment purposes in a combination of corporate debt obligations of varying maturities, other corporate income producing securities, and income producing securities of non-corporate issuers such as U.S. government securities, municipal securities, and mortgage-backed and other asset-backed securities issued on a public or private basis. Let's look at the chart of PTY. So when you buy a share of this, you're buying it at the net asset value. So we're looking at a chart here of the net asset value on a weekly basis. This goes back to 2016. You can see how this has been mostly rising. In addition to the net asset value or capital appreciation if the price moves higher, but they also pay a dividend or distribution on a monthly basis. Now, the price of this moves a lot like a stock, so if the price of the net asset value went down, then the total investment that you had in this would also move down. The dividend or the distribution may change just a little bit, but it holds pretty steady. So back in 2018, the market dropped, and this also came down with it. Then as the market went back up, it continued higher. When we had the collapse in the market in 2020, you can see that the price of this moved down. It since has come back quite a bit, or near the top here. So keep in mind, there is some fluctuation in price on these, so you do want to manage your investment. This is probably not something I would just buy and hold and just not pay any attention to at all. I would want to know what's happening in the market with my money and investment. The next area we're going to look at is the covered call area. We're looking at Global X Nasdaq 100 covered call ETF Qyld. This has a 12-month yield of 11.19%. So a fund like this, Qyld, their holdings are companies like Apple, Amazon, Microsoft, Facebook, Alphabet. They actually hold these shares and they write covered calls to generate income. Now, covered call writing's been around for a long time. Matter of fact, you can do covered calls yourself. One of our investors that watches our programs here, Ray, has told me how he actually uses covered calls on his own to generate some massive income. It does take an extra skill level to do it on your own. In this case, what the company's doing, they're buying the stocks and they're writing the covered calls and then paying you on a monthly basis on the distribution. So we're looking at a chart of Qyld here, weekly basis going back to 2016. You can see how it's going along real smooth until we had a dip in the market in 2018, recovers, and then 2020 we had the dip and pretty much recovered again. So you can generate appreciation by the net asset value increasing and also generate revenue with the distributions and the dividends on a monthly basis. They also use leverage like we mentioned on the income funds. So this is more of an aggressive strategy. However, if you manage it properly, we'll talk about managing your investment on a later video, but if you manage your investment properly, this can be a valuable tool for you to generate more revenue. We're going to take a look at the new V Nasdaq 100 Dynamic Overwrites, also covered call program, has a distribution rate of showing 6.36%. And so this covered call program also invests in the underlying stock here like Apple, Microsoft, Amazon, mostly in the Nasdaq 100. And it works much like the Qyld that we looked at, has the net asset value that you purchase, that can appreciate, then it also pays the monthly dividend. So we looked at two different strategies here using the CEFs or the closed-end funds. The first one was with the income-oriented funds where they're using bonds, either corporate bonds, government bonds. And then the second option was covered call writing where they're using the underlying stock, mostly these Nasdaq 100 stocks, and also writing covered calls on this. So what we're going to look at next is a bond fund. We're looking at Oyster Strategic Income Fund. This currently has a yield of about 4.3%. So again, better than in the savings account, but not quite as big as with these closed-end funds. We're looking at the top 10 holdings here for Oyster Southeastern Groceries Inc., XPO Logistics, Consolidated Energy, and so on here. So they invest in bonds from these various companies. This company's been very successful, Oyster has, and it's another way to generate more revenue on your saving. We're looking at the Oyster chart. Again, you can see it has a net asset value that you purchase on this. You can see that the net asset value has been going up. Keep in mind, bonds in general, the yield has been going down. So as bonds in general have been going down, the price of many of these bonds have been going up. So you can not only generate revenue on the bonds themselves, on the capital appreciation, but on the dividends. Now the dividends on this particular company are on a quarterly basis. Now if you're really conservative, you're looking for something that is not aggressive at all, but you want to get more than what you're going to get at the bank, this double line low duration bond fund is excellent. DLSNX right now has a yield of 2.38%. and also has a very low duration. So if bonds start to go up, the net asset value will not collapse. Now here's a chart of the DLSNX. You can see it had been steadily moving up as the bond prices are moving lower. We had the collapse in 2020. Now the reason for this collapse was bond yields actually went up, causing bond prices to go down. But you can see it has recovered. This is a very conservative fund. You can see there's really not a lot of fluctuation in the price. So we've been investigating how you can get a return of 9% with monthly dividends on your money. Again, these are more aggressive. You may only want 10% or at the most 20% of this in your portfolio, but it is a way to generate higher revenues than what you can get at the bank. So thank you for watching. Leave a message or comment if you have any other comments.